Recessions can be a once-in-a-lifetime opportunity as long as you know how to prepare and react. According to my YouTube analytics, most of you watching this are too young to have taken advantage of the 2008 financial crisis, and the COVID recession happened so quickly that most people didn't get a chance to buy the dip. So here are 6 things you need to do to prepare for and profit from the next recession, whether it's in 6 months or 6 years. Number 1 is pay down your debts, because there is nothing worse than going into a recession with a lot of high interest rate debt hanging over your head. Whether it's credit cards, buy now pay later, or student loans, those monthly interest payments will prevent you from investing and benefiting from the economic recovery following the recession. And if you're one of the more than 60% of Americans living paycheck to paycheck, those monthly interest payments could have much bigger consequences than just missing out on gains in the stock market. In my experience, most people that I talk to that feel like they're living paycheck to paycheck are just a few steps away from being able to save money and pay down their debts, which is why having a budget in place is so important. I'm sure you've heard this a million times from people like Dave Ramsey, but let me give you my 2 cents. You work too damn hard for your money and you owe it. Wait, can you say the word damn on YouTube? Sweet. You work too damn hard for your money and you owe it to yourself to keep track of where every dollar goes every month. It's not always fun and it's not always easy, but if I had to pick one thing on this list and ignore everything else, it would be budgeting. Now, I also understand that it can be very intimidating to create and maintain a budget even if you're making 6 or 7 figures a year. Which is why if this video gets 60 likes, I'll post a follow-up video on how to build and maintain a budget with just 1 hour per week. Now, if a recession does happen and you lose your job, not having an emergency savings could mean you also lose your car or even your home. An emergency savings will typically be between 3 and 6 months of your living expenses in a high yield savings account, which these days are yielding about 4% or more. And the more you have saved up, the more flexibility you'll have in case you do lose your job. After all, if you just have 1 month of living expenses saved up and you were to lose your job, you might scramble to find whatever job you can just to pay the bills, even if you end up taking a huge pay cut. But if you have 3 to 6 months saved up, this will give you the flexibility you need to find the best offer available and take as minimal of a pay cut as possible. Now, assuming that you have steps 1 through 3 locked in, you're ready to move on to the next section, which is how to profit from a recession. In order to profit from a recession, you'll need to have buying power for when assets start to drop in price. If your portfolio is in all stocks and it goes down 50% during a recession and you don't have additional money to invest, you're not going to be able to buy the dip and benefit from when asset prices start going back up. On the other hand, if you have 20 to 40% of your portfolio in stable asset classes like gold, bonds, and US Treasuries, you won't be as exposed to the broader stock market when it goes down, and you'll be able to reinvest those funds into other asset classes that you think will go up in value after the recession. This is the same strategy that many investors used to get rich in the 2008 financial crisis, with the stock market having gone up 600% since then. One of the most famous of these investors was Warren Buffett, who published an op-ed in the New York Times explaining why he was buying stocks and the importance of being greedy when others are fearful. But if I could add one thing to that quote, it's to be greedy, not stupid. After all, when stock prices drop, it can be really tempting to go all in on your favorite meme stocks or high growth tech stocks. But these are exactly the types of investments that have the most risk and could go completely bankrupt in a bad economy. On the other hand, there will be plenty of high quality companies that have the financial profile to make it through to the end of a recession, even if their stock price goes down 20 or 30 or 40% in the near term. These types of assets are typically much safer bets and will still have great payoffs in the long term. The main point that I'm trying to get across here is to always do your research, even when it seems like your favorite companies are on sale. While recessions can be a once-in-a-lifetime opportunity to build generational wealth, they can also be a once-in-a-lifetime opportunity to lose wealth, and that primarily comes from selling too early and not benefiting from the gains that happen after a recession. This is why once a recession starts and you've done your research and you've made your investments, it's important to hold for the long term and not sell irrationally out of fear. If you do have to sell because you need the money to survive, that's a completely different story. But luckily that won't be you because you found this video and you implemented steps 1 through 3. So now that you know how to prepare for and profit from a recession, you might be wondering how to profit from a normal economy when we're in between recessions. And if that's the case, you should check out this video where I talk about my favorite passive income strategies, or subscribe to my channel where I post content like this every week.